Greetings and welcome to the Tilt Holdings first quarter conference call. At this time, all participants are in a listen-only mode, and this conference is being recorded. Following the initial formal remarks, we will conduct a question-and-answer session. Webcast participants can submit a question directly through the webcast. Further instructions will be provided as the Q&A begins. Hosting today's conference will be Joel Milton, Tilt's Senior Vice President of Business Development. And now, I will turn the conference call over to Mr. Milton. Please go ahead, sir.
Thank you, operator, and good afternoon, everyone. Thank you for joining Tilt Holdings first quarter 2020 conference call. On the call with me today with prepared remarks are Mark Scatterday, Chief Executive Officer, Tim Conder, President and Chief Operating Officer, and Brad Hoch, Interim Chief Financial Officer, and we will discuss results for the first quarter. Our first quarter earnings release was issued after the market closed today, and a copy of that press release can be found on the Investor Relations section and on Tilt's website as well as on SEDAR. I would like to remind you that during this call, management's prepared remarks may contain certain forward-looking statements which are subject to risk and uncertainties, and management may make additional forward-looking statements during the Q&A. These statements do not guarantee future performance, and therefore undue reliance should not be placed upon them. We refer you to the forward-looking information disclaimer and all risk factors contained in the first quarter press release and in filings with the Canadian Securities Administrators for more detailed discussions of the factors that could cause actual results to differ materially from those projections and any forward-looking statements. The company undertakes no obligation to publicly correct or update the forward-looking statements made during the presentation to reflect future events or circumstances, except as may be required under applicable security laws. Finally, please note on the call today, management will refer to non-IFRS financial measures such as EBITDA and adjusted EBITDA, in which Tilt Holdings excludes certain expenses from its IFRS financial results. Please refer to Tilt Holdings' earnings release and Q1 filing for a full reconciliation of non-IFRS performance measures to the most comparable IFRS performance measures. At this time, it is my pleasure to introduce Tilt Holdings' Chief Executive Officer, Mark Scatterday.
Thank you, Joel. Many of you joined us 2 weeks ago on our fourth quarter earnings call. I'm happy to welcome you back today as we reconvene to discuss first quarter 2020. With me today is our President and Chief Operating Officer, Tim Conder, and our new Interim Chief Financial Officer, Brad Hoch. Brad enthusiastically supported and expedited our preparation to release first quarter earnings, and we feel grateful to have him on our team. We are super excited to report strong financial performance in the first quarter of 2020. First quarter revenue was $42.4 million, up 27% from fourth quarter 2019. The business earned $1.7 million in adjusted EBITDA and $4.2 million in cash flow from operations during first quarter. Underpinning these results was record quarterly revenue at Tilt's largest business, Jupiter Research, which generated $32.3 million in revenue during the first quarter, including a best ever month in January. This performance was up 35% sequentially and was driven by a robust inventory position built in the fourth quarter to prepare for the seasonal uptick in vape demand. This is typical of first quarters relating to the Chinese New Year supply chain disruption. What we could not have foreseen was the effect COVID-19 would have on the supply chain, which caused some of Jupiter's competitors to become customers during this time as the market wrestled with stockouts. Jupiter was well positioned with inventory to help address this confluence of strong seasonal demand and COVID-driven supply shocks, resulting in substantial operating profits and revenue 13% above prior year first quarter 2019. Jupiter's first quarter results were complemented by solid performance at Tilt's other business units. Our plant-touching businesses at Commonwealth Alternative Care in Massachusetts and Standard Farms in Pennsylvania generated $8.1 million in revenue in the quarter, up 5% sequentially, and continue to enjoy accretive operating margins. COVID-19's impact was felt in the latter half of March at Commonwealth Alternative Care, when the state temporarily closed recreational stores. Blackbird was able to successfully adapt to the rapidly changing regulatory and operational conditions in the California and Nevada markets to provide mission-critical distribution and home delivery solutions for our clients. These strong organic operating results reinforce our conviction in TILT's balanced portfolio of businesses, which offer multiple revenue streams and trajectories for increased cash flow generation and shareholder value creation. In its position as an industry-leading provider of inhalation technology solutions, Jupiter Research's highly geared operating model provides a foundation of consistent profitability and a wealth of quality client relationships that can be leveraged across other TILT businesses. Blackbird presents powerful upside growth potential as its uniquely comprehensive software and logistics platform provides enterprise solutions to some of the cannabis industry's most challenging pain points. And our plant-touching business at CAC and Standard Farms continue to contribute significant cash flow and provide a window into the market for testing and improving Jupiter and Blackbird products and services. I will now turn the call over to Tim and Brad to break down quarterly performance of our businesses in greater detail.
Good afternoon, everyone. As Mark noted in his opening remarks, TILT enjoyed strong sequential gains in Q1. During that quarter, Jupiter rebounded from muted Q4 activity levels as marketplace concerns about illegal black market vapes receded. Vaporization remains the second largest overall product category in the cannabis marketplace. Also in Q1, our vertically integrated plant-touching CAC operation in Massachusetts and cultivation and production unit Standard Farms in Pennsylvania were deemed essential businesses, allowing them to remain operational while COVID-19 stay-at-home orders were in effect. In Nevada, where recreational cannabis sales were restricted to delivery only on March 20th, our Blackbird retail delivery business rapidly scaled to provide its clients with an effective, comprehensive solution. With all of our operating units running at a high cadence during the quarter, TILT's gross margin increased from 20% to 27.7%. The firm also increased operational cash flow during the quarter with continued tight management of cash operating costs, which decreased to $11 million from $13 million in Q4. These savings were driven in part by cost structure realignment at Blackbird taken in Q4 and continuing through Q2 to respond to a changing market opportunities and accelerate break-even timeline. As a result of these operational efforts across our portfolio of businesses, balance sheet cash increased to $8.4 million at quarter end. We continue to focus on increasing cash flow and de-risking our operating model, especially important in a period when the capital markets are difficult to access and the macroeconomic environment continues to present multiple unexpected headwinds. Following Mark's comments introducing Brad Hoke, it feels appropriate to let Brad lead the discussion on Jupiter after the great job he did leading the finance function in that business unit prior to his promotion.
Thanks, Tim, and thank you to the board for this tremendous opportunity. I am thankful to be part of such a talented management team. It's an exciting time at TILT as all of our businesses are finding footing in a time of great growth and opportunity in the cannabis industry. Mark and Tim hit most of the highlights on Jupiter. Its Q1 record $32.3 million performance was up 35% quarter on quarter and 13% year over year. Continued to demonstrate the earnings power of Jupiter's lean, centralized operating footprint, which has proven to be durable and accretive to overall TILT results on an operating basis through a variety of market conditions. Q1 offered a tactical pricing opportunity for Jupiter in monetizing a strong inventory position during a seasonally high demand period, which proved beneficial to gross margins. Also during Q1, Jupiter brought to market the proprietary Infinity product platform and Liquid Q pod. We believe that these products offer long-tailed opportunity for gross margin expansion and reflect Jupiter's focus on providing safe, reliable, and unique inhalation technology solutions to help customers succeed in the race to build winning cannabis brands. After an initial rush of pantry stocking in mid-March, we began to see our customers take a more conservative stance in reaction to the COVID-driven changes in the macroeconomic climate. This shift in customer inventory positioning included customized orders, which represented the majority of Jupiter revenue during the quarter. As mentioned on our Q4 call, we see customized revenue as an indicator of the quality of our customer base, as demand for customized products is typically driven by larger, better capitalized clients. As was the case throughout 2019, we continued to experience no material E&O charges or challenges with canceled customer purchase orders across all the geographies where we operate. At this point, I'll hand it back to Tim to discuss Blackbird and our plant-touching businesses, CAC and Standard Farms.
Thanks, Brad. On our Q4 call a few weeks back, I provided a full review of the Blackbird business, so I will provide two updates here. First, steps we've taken to optimally align Blackbird's capabilities with changing market conditions related to the onset of COVID-19 in late Q1. And second, a summary of the rollout of our re-released Blackbird Go marketplace on the heels of our software integration completion last year. COVID-19 necessitated rapid realignment of our My Blackbird B2B logistics platform for brands and retailers in Nevada and California. When Nevada restricted adult use to delivery, Blackbird achieved best-in-class increases in basket size and volume for clients who outsource retail delivery with us. Our go-forward operating leverage has increased with the adoption of scheduled routing and other efficiencies, enabling our dispensary partners to reposition as micro-fulfillment centers as well as retailers. On the wholesale logistics side, we took a cautious approach to resizing our operations to fit the available opportunity in our core expansion market in California. There too, Blackbird created savings with scheduled deliveries. We also became more selective with our client base, more conservative with commercial terms, and more efficient with working capital. We revamped pricing for our logistics services to a more dynamic model, driven by data that we collect on each delivery through our proprietary distribution and delivery software. In Q1, we experienced material uplift in the combined impact of revised pricing, scheduled routing, and other operational rationalizations. These initiatives, coupled with the previously announced $3.5 million Blackbird cost-based realignment, have resulted in material gross margin gains and improved unit economics for the business. These efficiencies are major drivers behind TILT's $1.7 million sequential cash operating expense reduction that Brad will review later during the call. We also made headway in Q1 with our Blackbird Solutions B2C platform connecting brands and retailers to end consumers. The new version of BlackbirdGo.com, released on February 29th, featuring new advertising functionality, has been well received by the market, with some retailers and brands seeing click-through rates over 20%. We are validating the assumption that Blackbird will be able to drive revenue for brands and retailers through our marketplace and create a new channel of revenue for our partners. This is an important part of Blackbird's omni-channel approach to its goal of supporting brands with supply chain business solutions. Blackbird continues to hold strong upside as we work towards near-term break-even and the unleashing of its scale potential. With that, let's turn to performance of our plant-touching cannabis businesses. Revenue grew 5% sequentially from Q4 to Q1 in our plant-touching business segment. Commonwealth Alternative Care in Massachusetts and Standard Farms in Pennsylvania each experienced quarter-over-quarter top-line growth as well as material gross margin expansion driven by increased cultivation throughput and focus on higher yielding strains. These gains in sales and productivity were entirely organic without the activation of any additional retail space or the grant of any new licenses. The temporary ban on adult use between March 24th and May 25th in Massachusetts required CAC to make a rapid pivot to curbside dispensary sales and other COVID-19 enhanced safety protocols. While wholesale transactions with adult use manufacturers and retailers represented the majority of CAC revenue in Q1, our medical dispensary in Taunton has performed very well, with monthly dispensary revenue doubling during the ban period. Throughout this period, CAC also continued to build wholesale inventory in anticipation of the end of the adult use ban. Consistent with our recent Q4 earnings update on CAC, we continue to anticipate second half activation of the additional 50,000 square feet of Taunton cultivation and production space. We also continue to work with regulators to secure additional retail licensing for Taunton, plus our 2 locations in Brockton and Cambridge. These extensions of our CAC business are fully funded. During Q1, Standard Farms enjoyed strong increases in sequential top line as well as gross margin economics driven by greater output from its existing cultivation and production footprint in Whitehaven, Pennsylvania. This upward trajectory reflects ongoing optimization of greenhouse space activated in late Q2 of 2019. TILT continually evaluates available strategic options with respect to these plant-touching businesses in terms of the relative merits of retaining them versus potentially monetizing their value through divestiture. We are fortunate to have well-established businesses with great cash flow dynamics in rapidly growing limited license states. Beyond these attractive economics, CAC and Standard Farms play a valuable role serving as a test bed for products and services from elsewhere in our portfolio of businesses. This operator mindset yields unique insights and synergies which benefit the product development pipeline at our Jupiter and Blackbird platforms. Most importantly, it affords us a deep first-hand understanding of the challenges faced by cannabis operators. Also on the synergy front, we continue to make progress leveraging client relationships across our businesses, as Jupiter saw a 54% growth in revenue quarter over quarter generated from customers that are also on the Blackbird platform. We expect that number to continue to grow as we look to efficiently deliver our business solutions on an enterprise-wide basis. And with that, I'll turn it back over to Brad.
Thanks, Tim. There are a few Q1 financial highlights I'd like to drill into a bit more before we take questions. Before adjusting for changes in fair value of biological assets and inventory, the company's gross margin increased from 20% in Q4 of 2019 to 27.7% in Q1. Primary drivers in gross margin expansion were Jupiter's active role in addressing marketplace supply and demand imbalances, as well as greater efficiencies and volume growth in our cannabis business, particularly at Standard Farms. We continued to drive down costs during the first quarter to maximize operational efficiency. Excluding non-cash items such as stock compensation, depreciation, and amortization, operating expenses decreased $6.7 million, or 37% year over year. On a quarter-over-quarter basis, this decrease was 13%, or $1.7 million. Of that $1.7 million total sequential decline, $1.3 million was from a 21% quarter-over-quarter decrease in compensation and benefits expense, partially driven by headcount decreases related to realignment of the Blackbird business. Also in Q1, our ongoing focus on balance sheet management yielded a material $6.4 million paydown of outstanding payables. The strong revenue performance, gross margin expansion, and greater operational efficiency combined to drive TILT's $4.2 million in cash flow from operations during the quarter.
Thanks, Brad and Tim. While no one could have predicted the volatile first quarter of 2020, our performance under these conditions illustrates how TILT creates and provides solutions for our customers regardless of the environment. It is in these moments when TILT's nimble, lean, and balanced portfolio of businesses truly shine through. I remain confident in TILT's ability to continually adapt to meet our customers' mission-critical needs while building scale and shareholder value in our gold standard market-leading businesses. Thank you.
Great. Thanks, Mark. We'll now be happy to answer your questions about TILT and our first quarter results. First, the operator will open the line for any equity analyst questions before we turn to the questions that we've been receiving from shareholders via our open web question submission system. Operator, are there any questions from our equity analysts?
Yes, we do have questions from the telephone. Our first question comes from Aaron Gray with Alliance Global Partners. Please state your question.
Hi, thanks for the question, and congrats on the quarter. Really nice job on improving top and bottom line metrics sequentially. So my first question is around Jupiter. Nice to see that improvement sequentially. One thing you guys did mention was in terms of there was some selling that went to some competitors during the quarter. So could you help to maybe quantify, how much of that was included in revenue during the quarter? And then just also wanted to dig a little bit deeper in terms of some commentary you made in terms of it seems like the purchasing orders that you've seen so far in 2Q might have been more conservative. So just if you could give some more color in terms of, how best to think about that, were they stocked up on inventory heading into 2Q and then maybe more slow on replenishing to be expected in the quarter ended June? So just color commentary on that would be helpful. Thanks.
So I appreciate that. I'm trying to understand, the questions. Let me handle the first part. I don't have the numbers specifically when we talk about our competitors becoming, our customers. However, it was quite significant. Our competitors did rely on utilizing Jupiter inventory, to satisfy their customers' needs, of which we had pretty deep inventory positions that we can manage and be able to provide that inventory, to the customers. Do you mind if you can, Aaron, can you restate, the second part of that question?
Yeah, no problem at all. I think Brad had mentioned how some of your customers have been a little bit more conservative, I think is how he worded it, in terms of what we're seeing more to date in terms of the purchasing habits. I think he was referring to Jupiter and potentially sales you're making to MSOs or other manufacturers. Just want to see how purchasing trends might have, changed as we got deeper into the impact of COVID after the first quarter ended.
Sure. Thanks, Aaron. Yeah, and that really, exactly right. It goes more towards Q2 and forward looking. We did see some, just the uncertainty in the economic market today. I think there was some, from the buyers out there, we've seen some hesitancy to really fill their normal inventory needs. We're seeing that subside now. With the stay-at-home orders, the unemployment rate to where it was, I think there was some uncertainty in the marketplace that's starting to subside now.
Oh, great, thanks. That's helpful. And then just turning over to the plant-touching assets, specifically on Massachusetts. Great to see that both Mass and PA saw a sequential uptick in the quarter. But just as we look towards the second quarter, where again more of the impact from COVID is going to be felt, specifically on Massachusetts. I know you mentioned medical sales in the dispensary were roughly doubling, but as we look at the wholesale business and the impact that was felt by COVID, and then what we're seeing the uptick since some of those quarantine measures were lifted, it looks like when I look at the state data. For retail throughput, it's rebounded quite nicely to date. So just want to know how much of that is to kind of read through on the wholesale side, whether or not your customers on the wholesale side were kind of already replenished on inventory and didn't really need to buy more on the wholesale market, or kind of what trends you're seeing since some of those quarantine measures with click and collect and curbside pickup have been eased.
Yeah, I can take that one. Thanks, Aaron. We appreciate the question, man. I guess I would say that the state data is reflective of our own sort of internal dynamics, which was, people were sort of holding their inventory positions, especially adult use retailers in the state while the ban was implemented. But with the reopening of the state, we saw that ease quickly, right? And so, there is a drop in revenue for Q2 from a wholesale perspective, but an increase, like we mentioned, in retail, up that essentially doubling during the period and sort of continuing strong with the reopening of the state. But like we also mentioned on the call, we continue to build our reserve of product so that we would be ready to facilitate the demand once the state reopened, and that's what we're seeing happen right now.
Okay, great. Thanks. That's helpful. And then last one for me is just going to be on the Blackbird business. So you guys mentioned kind of the uptick you've seen, in delivery and also on the wholesale side, amid COVID. Just want to know how best to kind of quantify that. Like, how big on an absolute dollar basis is that relative to your technology and distribution revenue? So when we see like a notable uptick there quarterly, how much of a magnitude should we think that impacts the top line, and then also any potential margin implications for the delivery business relative to the rest of the portfolio? Thanks.
Yeah, no, absolutely. Thanks again, Aaron. So, during the onset of COVID and the restrictions in the state of Nevada to relegate cannabis purchases to delivery only, we reported in a press release at that time that we saw an uptick of 600%, which was real for us at the time. And while obviously we've seen that number decrease with the reopening of dispensaries in the state of Nevada, we have not seen it fall all the way back to pre-COVID levels. So not only are we seeing continued increase in top line revenue for that line of business, retail delivery, but also, as we indicated earlier in the call, gross margins gains because of how we sort of restructured the delivery model itself. So, I would say those gross margins gains basically took the gross margin from negative into the positive range, and top line revenue increased commensurate with the volume increase that's represented in our earlier press release, at least temporarily during the ban. Does that answer that for you, Aaron?
Yeah, absolutely. Super helpful, and I'll jump back in the queue.
Awesome. Thank you.
Thank you. Our next question comes from Bobby Burleson with Canaccord. Please state your question.
Hey, guys. Just curious, I appreciate the discipline on spending and the cash flow generation. Curious, though, in terms of investment in the Blackbird business, what kind of opportunity you guys see in enabling e-commerce for brands and helping them go direct to consumer without the dispensary. And, if California is a good market for that, if there are other markets, and is there a lot of investment involved on your end if you're going to engage more aggressively there?
Hey, Bobby. Thanks for the question. I think it's a great one. I would say California is a perfect market for direct-to-consumer operations because of the license class structure. There's a non-storefront retail delivery license, which effectively enables brands to go direct-to-consumer. So I would sort of target California as the sort of perfect expansion state for a direct-to-consumer investment. We are well situated to be able to capitalize on that direction, which we think the cannabis market overall will take over time. Brands are always looking for new ways to reach consumers directly and through multiple channels, and that's something that we continue to watch closely and be very interested in. We say that our platform is to provide business solutions for brands and retailers, brands obviously being an important part of that. The facilities that we currently have in California would be able to not only be leveraged as distribution centers, but also house non-storefront retail delivery licenses. So the CapEx expenditure for us to be able to offer that line of business is not large. Hopefully that answers your question, Bobby.
Yeah, it does. Great. And then another one from me would be, you guys have a lot of access to data in terms of consumption patterns with your dispensary customers on the POS side or the customer engagement side. Wondering what you're seeing there in terms of consumption mix. Has there been any shift away at all from vape, given COVID and the respiratory concerns there? We do hear edibles companies kind of talking about some benefit towards their product format. Wondering if you're seeing anything there that's meaningful as it relates to Jupiter.
Yeah, I mean, I would say we've seen a significant return to vape post Vape Crisis. Has been sort of the most material thing that the most material item that we've gathered from our data. Product mix based on state continues to ebb and flow, right? And in certain states, edibles are gaining some ground, but not from vape, at least from the data, what our data shows, but more from other product categories, specifically flower. So I think the overall sentiment is consumers continue to want variety. New consumers want to try things, and edibles are a low barrier to entry, even though they might be pretty potent for some.
Sure. And then just one last one from me, looking up to Canada, Cannabis 2.0. What's the opportunity for Jupiter there? Are there any signs that, that's, a nice market opportunity? Things are fairly dynamic, I think, right now in the near term in terms of how that's rolling out.
Yeah, Bobby, I can take that one. This is Brad. We are currently doing business. We're currently doing business with quite a few of the big MSOs there. We're also talking to a few that not current clients either right now. So we're very very excited about what Canada 2.0 is going to bring, at least on the Jupiter side.
Great. And is that, obviously you've benefited as a tier one supplier of hardware solutions, and I think people are more wary these days of, the low end. Is that helping at all in your engagement, in prospecting up there?
Yeah, Bobby, this is Mark. It definitely has been. I get reports, from the leaders of our sales team that that's a lot of the questions and a lot of the attention is the Jupiter, just being kind of the gold standard and our quality control in all of our practices, that exist overseas. So that's definitely one of the major topics, in any engagement, with our customers.
Great. Thanks.
Thank you. Are there no further telephone questions at this time?
Great. Thank you, Bobby and Aaron, for the questions, and thanks, operator. We'll turn now to some of the questions that came through the webcast. Mark, first question will probably be for you. A couple people asking about Smore. Looks like there's a planned IPO, and is there any impact there? Does it help or threaten? Can you speak to that, please?
Yeah. First of all, I'm really happy, for our partners and those guys, in China, at Smore. They are planning for an IPO. Jupiter's relationship with Smore, truly has never been stronger. Their success is our success. Any and all the additional resources will only help fuel the innovation, between our companies.
Great, thanks. Next question, also for you. How does Jupiter defend its market share? And how is Jupiter different from other vape companies or distributors?
This comes up a lot, but first and foremost, Jupiter Jupiter's an innovator, not just a distributor, and it's one of those things that's probably a big misnomer of people really understanding our business. Our customers, really lean on us for quality, reliability, innovation. Together with Smore, we have a really strong IP portfolio, and I think we'll be maintaining our leadership position, not only defending our current, intellectual property, but as well as future product advancements and innovation.
Great, thank you. Tim or Brad, next question's about a couple more questions around the cash position and any planned raises. I know we talked about this 2 weeks ago, but maybe something has changed.
Yeah, no, I can take this one. This is Tim. We'll always continue to evaluate opportunities available to us, but, from a capital perspective. But as it stands right now, we don't have any, large capital expenditures, and we generate cash from our current and existing operations. So we're going to continue to focus on increasing the amount of cash that we generate internally, rather than focus on capital markets. But again, we evaluate all options.
Great. What is the plan for, I think this says institutional investors, or institutionalizing the investor base?
Yeah, I think, we've been pretty candid about taking essentially the past year since Mark came on as interim CEO to stabilize Tilt's business. And, given this quarter's results and our continued focus on operational efficiency and generating cash, I think that we feel like the business has been stabilized, and we look to really, reach back out to institutional investors to understand, to help them sort of understand our story and kind of continue to build on what we've been working on over the past year.
Great. And then one or two just asking, what the main focus is in various ways. Where do we see the actual business, and how do the pieces fit together?
I guess I can kind of sum it up in one sentence. Tilt is a business solutions provider to cannabis operators with a deep understanding of plant-touching operations. And that's where we'll continue to allocate our resources, is to being the best cannabis business solutions provider that we can be, and better understanding our customers and clients.
Great. And then I guess last question we can end on is, a couple questions on growth. Where do we see the biggest opportunity over the next few quarters? Other people asking about the next several years. What does the future of Tilt's growth look like?
Tim, I'll go ahead and speak to that. As we talked about on our last call, we are currently broadening our footprint in the foreign markets, but there's a lot of opportunities domestically. Regardless of where, the business plan is simple: selling existing products to new customers, as well as selling new products to existing customers. What we won't be doing is selling new products, to new customers. That's definitive of a risky startup.
Great. Excellent. Well, this concludes Tilt's first quarter 2020 conference earnings call. Thank you to our analysts who joined, as well as everyone else, and for your questions that came through. I appreciate it. Thanks, guys.
Thanks, everyone. Appreciate it.
Thanks, everybody.
Thank you. This concludes today's conference. All parties may disconnect. Have a good day.